Born in Budapest in 1906, André Kostolany embarked on his extraordinary financial journey as a broker in Paris in 1927. This pivotal year marked the beginning of a career that would span over 7 decades, witnessing some of the most dramatic economic upheavals and recoveries in modern history. His early exposure to the markets in the vibrant pre-Depression era of Paris provided him with a unique vantage point, shaping his nascent understanding of speculation and risk. Throughout his life, Kostolany demonstrated an almost uncanny ability to accumulate vast fortunes, lose them amidst global crises, and then methodically rebuild them, often by astutely identifying opportunities in post-war reconstruction, such as his strategic investments in the rebuilding of Germany after World War II. This cyclical pattern of wealth creation, destruction, and recreation was not merely a testament to his resilience, but a profound illustration of his deep, almost intuitive understanding of market dynamics and the long-term ebb and flow of economic cycles. He was a survivor, a visionary, and a perpetual student of the market, learning from every boom and every bust. His experience wasn't confined to one continent. He navigated the financial landscapes of Paris, New York, and Germany, each contributing to the multifaceted perspective that defined his unique approach. Beyond his practical exploits, Kostolany was a prolific author, penning 13 books that collectively sold over 3 million copies, cementing his status as a thought leader in finance. He also contributed 414 insightful articles to the prestigious German magazine Capital, sharing his wisdom with a broad audience. His final literary masterpiece, The Art of Thinking About Money, stands as his intellectual testament, meticulously distilling and summarizing the accumulated wisdom of his many decades spent grappling with the complexities of the financial world. It is a work that encapsulates his lifetime of observation, speculation, and philosophical contemplation. Central to Kostolany's philosophy was his assertion that the market is far more than a mere collection of numbers, charts, and financial reports. Instead, he viewed it as a complex, dynamic interplay between two fundamental forces: money, representing liquidity and the sheer volume of capital available for investment, and psychology, encapsulating the collective emotions, sentiments, and often irrational behaviors of investors. His most famous and perhaps most enduring analogy, that of the man with the dog, vividly illustrates this crucial relationship. In this analogy, the man represents the real economy, moving steadily and predictably along its path, while the dog symbolizes the stock market, frantically darting ahead, lagging behind, or veering wildly off to the sides. Yet, despite its erratic movements, the dog, the market, is always tethered to the man, the economy, and will eventually return to its master's side. This analogy powerfully conveys that while the market can, and often does, deviate significantly from the underlying economic reality, such deviations are temporary. Ultimately, the market will always recalibrate and realign with the fundamental economic trajectory. This understanding is critical for investors, reminding them not to be swayed by short-term market exuberance or despair, but to keep an eye on the long-term economic fundamentals. Kostolany further elaborated on the two primary drivers of market behavior. Firstly, liquidity, the sheer amount of money available for investment. This factor is often heavily influenced by the monetary policies of central banks, particularly their decisions regarding interest rates. Lower interest rates typically mean cheaper borrowing, encouraging more money to flow into investments, while higher rates tend to restrict this flow. Understanding the direction of liquidity is paramount. Secondly, psychology, the prevailing mood and sentiment of investors. This can range from rampant optimism and euphoria, leading to speculative bubbles, to deep-seated pessimism and fear, precipitating market crashes. Kostolany recognized that these collective emotions are powerful, often overriding rational analysis in the short term. He also highlighted the paradox of news. The market's reaction is not simply to the news itself, but rather to the difference between what was anticipated and what actually occurs. This means that seemingly bad news might paradoxically lead to a market rally if it turns out to be less negative than the market had already priced in or expected. Conversely, good news might trigger a sell-off if it fails to meet overly optimistic expectations. This nuanced understanding of news impact underscores the market's forward-looking nature and its constant discounting of future events. These foundational insights paved the way for Kostolany's 7 Unbreakable Rules for Success on the Stock Market, principles that transcend specific market conditions and offer a timeless guide for investors. 1. Be a speculator, not a gambler. Kostolany drew a sharp, crucial distinction between these two archetypes. A speculator, in his view, operates with a clear, long-term vision, meticulously conducting analysis and exercising immense patience. They are guided by a reasoned assessment of probabilities and underlying value. Their decisions are rooted in a thoughtful understanding of market cycles and economic fundamentals. In contrast, a gambler is driven by raw emotion, short-term impulses, and an often naive reliance on sheer luck. Gamblers chase quick gains, are easily swayed by rumors, and lack a coherent strategy, making them highly susceptible to market volatility. The practical implication of this rule is profound. Resist the urge to succumb to panic during market downturns, or to be swept away by euphoria during periods of rapid ascent. Instead, cultivate a disciplined approach. Formulate a clear investment plan based on thorough research, and crucially possess the fortitude to adhere to that plan, come what may. This requires self-awareness, emotional control, and a commitment to continuous learning. A speculator understands that the market is not a casino, but a complex system that rewards methodical thinking and strategic positioning. They are prepared for both gains and losses, viewing each as part of the learning process rather than a definitive outcome. Second, act anti-cyclically. This rule strikes at the very heart of conventional wisdom and challenges the most deeply ingrained human tendencies. Kostolany emphatically declared that the greatest impediment to financial success is the pervasive herd instinct. He passionately advocated for a counterintuitive approach. Buy when everyone else is selling, when the market is gripped by fear and pessimism, and assets are undervalued. This is the phase of accumulation after a significant market decline. Conversely, sell when the masses are enthusiastically buying, when euphoria is rampant and prices seem to defy all rational valuation. This is the phase of distribution preceding an inevitable market correction. This strategy demands extraordinary psychological resilience and the rare ability to deliberately go against the prevailing market sentiment, which can often feel like swimming against a powerful current. It requires a profound conviction in one's own analysis and the courage to act independently, even when surrounded by widespread panic or irrational exuberance. Going anti-cyclical means buying into weakness and selling into strength, often when it feels most uncomfortable to do so. It means being a contrarian, not for the sake of being different, but because market extremes often present the best opportunities for long-term value creation. This is where patience truly becomes a virtue, as waiting for the right moment to act, rather than reacting impulsively, is paramount. 3. Ignore the crowd. Don't believe others know more. This rule is a direct extension of the anti-cyclical approach and a powerful warning against the dangers of groupthink. Kostolany observed that widespread buying of stocks does not automatically imply that the collective crowd possesses superior information or insight. The motivations behind mass market movements can be incredibly diverse, ranging from genuine belief to speculative frenzy, from institutional rebalancing to algorithmic trading. Drawing definitive conclusions from such mass actions can be exceedingly perilous for the individual investor. His own life offered a stark illustration of this principle. Kostolany famously navigated the treacherous waters of the 1929 stock market crash, demonstrating remarkable foresight by strategically taking short positions, effectively betting against the market when the majority was still caught in a speculative bubble. The practical takeaway here is to be acutely wary of the fear of missing out, FOMO, especially during periods of rampant market mania. This emotional bias often compels investors to jump into overvalued assets simply because everyone else seems to be making money, thereby exposing them to significant risk when the inevitable correction occurs. True independence of thought, based on one's own research and conviction, is a hallmark of the successful investor. 4. Profit on the stock market is a reward for suffering. This profound statement underscores Kostolany's realistic and somewhat stoic view of market dynamics. He consistently emphasized that market risk is not an abstract concept, but a very real, tangible component of investing. And it is precisely this risk that serves as the wellspring of long-term profits. True success, he argued, does not come easily or without cost. It is often preceded by periods of significant discomfort, pain, and even financial losses, which an investor must possess the mental fortitude and financial capacity to endure. This rule highlights the absolute necessity of having strong hands. A term Kostolany used to describe investors who possess the requisite time horizon, sufficient capital, and critically, the emotional resilience, the nerves, to weather inevitable market fluctuations, downturns, and periods of uncertainty. These strong hands are able to hold on to their investments through rough patches, confident in their long-term thesis. This stands in stark contrast to shaky hands, typically smaller, less experienced investors who are prone to panic selling at the first sign of trouble, often locking in losses and missing out on subsequent recoveries. Understanding and accepting that market volatility is an inherent part of the journey, and that patience through adversity is rewarded, is a cornerstone of Kostolany's philosophy. 5. Buy stocks and take a sleeping pill for 20 years. For the vast majority of individuals, Kostolany believed that the most effective and least stressful strategy was long-term investing. His vivid recommendation was to purchase shares in fundamentally sound companies, then metaphorically, take a sleeping pill for 2 decades, deliberately disengaging from the daily news cycle and the constant barrage of market commentary. The rationale behind this seemingly radical advice was to circumvent the detrimental effects of emotional decision-making, which is often triggered by short-term market noise and sensational headlines. By adopting a set-it-and-forget-it approach over a significant time horizon, investors could harness the immense power of compounding returns, allowing their investments to grow exponentially over time, undisturbed by fleeting market sentiments. This advice forms the very bedrock of the buy-and-hold investment strategy, championing the idea that time in the market, rather than market timing, is the ultimate determinant of long-term wealth creation. It emphasizes that consistent patient investing in quality assets, shielded from the psychological traps of short-term thinking, is a path to enduring financial success. 6. Money and psychology are the main market drivers. While this concept was introduced earlier as a philosophical cornerstone, Kostolany reiterated its crucial importance as an actionable rule. He firmly believed that the medium-term trend of the stock market is determined less by immediate fundamental facts and more by the interplay of liquidity, money, and the collective sentiments of investors. Psychology. This rule forces investors to look beyond the surface-level narratives and understand the deeper currents at play. Central banks, through their control over interest rates and quantitative easing tightening policies, exert a profound, albeit indirect, influence on the volume of money available to flow into the market. Their actions can either fuel market growth or stifle it. Simultaneously, the prevailing psychological mood, whether it's optimism, greed, fear, or despair, can amplify or diminish the impact of liquidity. For an investor, the critical implication is the absolute necessity of emotional restraint. Cultivating the ability to detach oneself from the prevailing emotional climate of the market is paramount for maintaining an objective, analytical approach. This means not getting carried away by irrational exuberance during a bull run, nor succumbing to despair during a bear market. Understanding how these two forces interact provides a powerful lens through which to interpret market movements and make more informed, less emotionally driven decisions. 7. Adapt risk to your capital. Kostolany's final rule is a pragmatic acknowledgement of individual circumstances and a call for personalized risk management. He categorized investors into three distinct groups based on the volume of capital at their disposal, each requiring a different approach to risk. Firstly, those with substantial capital are in a position where they can reasonably engage in speculation, as they have a buffer against potential losses and the capacity to diversify. Secondly, those with limited capital should not engage in active speculation, as the potential for significant loss relative to their overall wealth is too high, and they lack the financial cushion to absorb setbacks. For this group, long-term diversified investing is generally the safer and more prudent path. Thirdly, and most controversially, those with very little capital are, in a sense, forced to speculate, as their existing capital base is insufficient to generate meaningful returns through conventional, low-risk investing. For this group, the potential for higher returns, despite higher risk, might be their only path to significant wealth accumulation, though it comes with extreme caution. This nuanced perspective underscores the critical importance of developing an investment plan that is meticulously tailored to one's personal financial circumstances, including income, savings, existing assets, and, crucially, one's individual tolerance for risk. It's a reminder that a one-size-fits-all approach to investing is fundamentally flawed, and that self-awareness regarding one's financial position is as vital as market knowledge. While the intricate landscape of global financial markets has undeniably undergone a radical transformation since Kostolany first penned his insights, from the advent of algorithmic trading and cryptocurrencies to the instantaneous flow of information across continents, the fundamental psychological and economic principles he so eloquently articulated remain remarkably, almost defiantly, immutable. His unbreakable rules are far more than mere historical anecdotes or charming relics of a bygone era. They are robust, practical instruments, sharpened by decades of experience, that continue to offer invaluable guidance for any investor or trader who genuinely aspires to achieve enduring success in the long term. His wisdom emphasizes the timeless virtues of patience, the profound power of counterintuitive thinking, and the critical importance of a deep, empathetic understanding of human psychology's pervasive influence on market behavior. It's a call to look beyond the noise, to cultivate independent thought, and to recognize that the human element, with all its hopes and fears, remains the most potent, albeit often unpredictable, force in the financial universe. Understanding the human element in finance, the raw emotions and grand narratives that have shaped market history, is just as crucial today as it was in Kostolany's time. While his rules give us a framework, truly grasping the cycles of greed and fear, the panics and manias, often requires looking back to those who lived through them. If you're fascinated by the historical tapestry of market behavior and the legendary figures who navigated its turbulent waters, then you'll find profound value in 50 Years in Wall Street by Henry Clews. This illustrated two-volume memoir offers a vivid first-hand account spanning half a century of Wall Street history, from the devastating panic of 1857 right through to the excesses of the Gilded Age. Clews doesn't just chronicle events, he brings to life the stories of eminent financiers, revealing the intricate dance of market manipulations, the triumphs, and the spectacular failures that defined an era. It's an unparalleled opportunity to immerse yourself in the psychological and strategic battles waged by the titans of finance, offering a unique perspective that directly complements Kostolany's timeless wisdom about human nature and market cycles. For anyone seeking to deepen their understanding of how historical patterns continue to echo in today's markets, and to gain invaluable insights from the experiences of those who built, and sometimes broke, Wall Street, this book is an essential read. You can explore these fascinating insights yourself. A link to 50 Years in Wall Street by Henry Clews is in the description below. Don't miss the chance to connect with the raw, unfiltered history that continues to shape our financial present. Ultimately, Kostolany's enduring message is a powerful reminder that the most sophisticated algorithms and the fastest trading speeds cannot fundamentally alter the two core drivers of market behavior: the availability of money and the collective psychology of those who wield it. By mastering these two forces, and by diligently adhering to his 7 unbreakable rules, investors can equip themselves with a robust framework for navigating the complexities of the stock market, not just for fleeting gains, but for sustainable long-term prosperity. His legacy is an invitation to think deeply, to act patiently, and to trust in the timeless wisdom that transcends transient market fads.